All right, so we're just gonna get started on a basic introduction to the stock market for our first webinar, and this will just help you provide a basic understanding of everything that's most important. So what, why, and when? So the stock market is a collection of companies, and they're open for investment. The stock market, you can go onto the stock market, companies can get onto it with an IPO, an initial public offering, in which they raise funds through a series of funding, Series A, Series B, Series C funding, and then from there they go onto the market in which they're given a share price based on the shares outstanding and the market cap of the company. Um, the NYSE was founded in 1790 in New York City, and this is by far the biggest stock exchange. Uh, Advanced equities were primarily looking at companies that trade on the NYSE, and most brokers provide access to buy companies on the New York Stock Exchange. Uh, from 9:30 a.m. Eastern to 4 p.m. Eastern, the stock market is open, and from there, people are trading, buying, and selling stocks. Stock markets, exchanges, and indexes. So the stock market is the process and facilitation of investors buying and selling stocks with one another. So in this process, it's you're buying low and then you are selling high, right? Because you're trying to make a profit. That's just basic arbitrage, and that's what people are doing on the stock market. The stock exchange is the actual intermediary that connects buyers with the sellers. The exchange, like the New York Stock Exchange, stuff like that. They connect you with buyers and sellers, and that's great. It's very easy to use, and from there you can connect with a broker. They'll connect you with that, so it's great. The stock index is a numerical representation of a group of stocks that is used to track their collective performance. So the most important indexes are things like the S&P 500 and the Nasdaq, in which you can track the basically the whole market is what you use indexes for. All right, so do not confuse. So the stock market is not where cryptocurrencies are traded. It is also not where futures are traded, and it is not where bonds are traded. Those are all traded on different markets. Cryptocurrencies, you can act with a crypto broker. Some of the Coinbase. Coinbase is one of them. Futures are traded with the Chicago Mercantile Exchange, and those are also connected with different brokers. And bonds, you trade those. Typically, the ones we buy are with the government, but you may buy company bonds too, and you connect with the company or the government. Real estate is also not one of the things traded on the stock market. You connect with a realtor for that, but it's not on the stock market. So that's just something to recognize when thinking about the stock market. Popular companies. So the most popular right now is of course NVIDIA. This market cap's a little wrong. It's around three. I want to say it's 3.1 trillion right now. And Microsoft is a around that area. I think they're at 3.3 trillion now. But it just kind of shows how big these companies are. Um, these are very large companies, and they achieve these market capitalization for the shares outstanding times their stock prices, which is a very important formula to remember because that's gonna be market cap. Market cap's one of the most important things when thinking about what kind of company you're investing into, small, medium, or large, or super mega cap. So stuff like that. Also, there's a range. So, McDonald's, you can also invest in those companies. GameStop, that was big. Trump Media and Technology, that's one that's very popular right now. And also Monster Beverage. Sentiment. So, a bullish sentiment is typically associated with optimism about the future of the stock market. You believe that stocks will go higher, and in that instance, you're buying stocks from the broker. In a bearish sentiment, you are pessimistic. You think that stocks will go lower. And in that instance, you are shorting a stock, is what it's called. And to supplement that, I have a short video, and I think this will help. All right. Let's see. So we'll go back to the presentation real quick. All right, so that kind of just explained what a short sell is. I know with an iPhone, you obviously know that it's going to be worth less in the future, but when you doing it with stocks, you are connected with a broker and you're borrowing shares. You don't actually own them. You're not selling something that you're selling it back to the broker. It's very confusing to explain, but I think with the iPhone, that's probably the best way to explain it. And it's something just to think about. But primarily advanced equities, we are looking at stocks, we are buying the stocks, we are not typically short selling, but we will get into that later into the summer. So stock analysis, there's two primary analysis types. There's technical analysis and there's also fundamental analysis. In technical analysis, you see these and images of the people trading stocks, big companies. They have these huge computers with these charts on their screen. And these charts do show information about the company, but they do not provide the information that's provided with fundamental analysis. With fundamental analysis, you're looking directly at what the company is doing, how they're making their money, what their costs are, and their overall earnings or net income. And just for example, I mean, both of these technical and fundamental you can use to predict the future of the stock with certain trends, but fundamental analysis is a little bit more accurate. And just for example, for Nike, we bought it in November. um, this was a time when the stock was it was trading at like normal levels, but we looked more into it and we found issues with the company. And from that, we actually got a terminal value a lot less than what we expected. And from there, we almost instigated a short and we said that the stock was going to go down because we found that it was actually worth $80 at the time instead of the $107 that it was trading at. And from there, it actually fell to $73, which was awesome and just kind of shows how fundamental analysis works and how it is somewhat accurate and it does provide a lot of information about companies. So types of people in the stock market. There's day traders. They typically leave all their positions when the market closes. There's also swing traders. They exit their positions within weeks and up to a few months. And then investors are leaving positions after 1 year or longer. That's typically how you classify it. So an investor is what advanced equities, that's what we're trying to teach. We are trying to teach investing because we feel that long-term growth is outweighs short-term profits. Um, some of the big investors here are, of course, Warren Buffett, Bill Ackman. They trade other people's money. Well, they invest with other people's money, which is what we would all like to achieve one day as investors, right? So they make a lot of money from this, though. Warren Buffett, he's worth billions of dollars, and he's used strategies that we'll look into as well. Timing the market is definitely the hardest part of the overall game of the stock market. These things like financial crises that are setbacks and people get scared. So for an example, we got like around 2008 right here with my mouse, and you can just kind of see this downfall here. So in this instance, 2008, 2009 area, of course, there was the financial crisis, the housing market collapsed, and with that, the S&P also came down as well. That just is a result of recessions and stuff like that. But in this instance, let's say you bought the stock right before the recession. Oh yeah, I just entered the stock market. I'm gonna make all this money, but then you lose all this money super fast, and you're like, why did this happen? This isn't supposed to happen. This is supposed to be safe. And that's the thing that people get confused is that the stock market is not guaranteed profits. I mean, in the long term, it typically has gone up, but the stock market is not always guaranteed to make you money. So people that may lose, I don't know, 20% of their portfolio, they get really scared and they just start pulling out. They're like, I don't want to be in this anymore. And that's when people incur losses in those short-term gaps. And that's why it's kind of just better to stay in it for the long term. Stay in the stock market for the long term, and you can achieve profits like that. Just another example is Microsoft. 20 years ago it was $1,000. If you had $1,000 you bought Microsoft 20 years ago, it would now be $25,000, which is outstanding. That is outstanding performance, and it just kind of shows that there are areas where and times where the stock goes down, and that's something you do have to worry about. But if it's not down 99% or something like crazy like that, then maybe you should just think about your discipline, what you went into the trade for and why you're still in the trade. So just stay safe and don't be overly cautious when you're trading the stock. So how to enter the stock market? So we can enter the stock market through brokers. They used to be actual people. You can see in the corner these people you used to call them, and they would fulfill the trades for you. But now we have technology that does it. Companies like Webull, Robinhood, Interactive Brokers, they all accelerate this process. But you do need to be 18 to trade on the stock market, which is unfortunate. Most of us have advanced equities are not 18 yet. But the good thing is that we are trying to teach students to better understand investing so that when they are 18, they can go into the stock market with confidence that they're not going to lose all their money. Because that's just why would you enter the stock market? You have to be cautious when you're entering it. You're exposing yourself to a lot of risk. So it's very important to understand the stock market before entering. All right. And from there, we're just going to move over to Yahoo Finance. Let me just move this here. So Yahoo Finance is a great website. It's pretty is a lot of information. They provide news articles. I don't typically read these news articles, but they are free and they're not bad. But something great about this is that they provide a lot of information about companies. So we can look at a company like AT&T. From here we can find, the chart of the company. We can look at this chart. We won't use this as our main charting platform, but they also provide all of this information. And the great part about it is the financial statements. So financial statements we will use in webinar 2 and also webinar 3. Webinar 4, we're looking at technical analysis, so that's great. But from webinar 2 and 3, we will be using this page. And this is where we'll gather some of our financial information when trying to predict and use our cash flow models. So that's awesome. And I think that's about it for now. I hope to see you guys next Thursday. And yeah, that's it. Thanks for joining.